Joining me is the CEO of Chargepoint, Pasquale Romano. It's great to see you again. And are you getting any indications of sort of an uptick in interest in buyer demand?
Well, first of all, thanks for having me back, Kelly. Appreciate the opportunity. We've seen tremendous demand for electric vehicles, which in turn drive demand for our products throughout the year, even before all of the global events that are impacting oil prices. So I think consumers already understand that driving electric is just a better way to drive.
At the same time, the economics, as I was driving in this morning, the lowest price I saw to fill up was $3.73 a gallon. So, of course, there's a pinch there, and people might look to EVs. But if you take a Tesla Model 3, which is not the cheapest one out there, obviously, but just as an example, its price is up $6,000 over the past year. So it's not exactly either way, you're facing higher costs. You know what I'm saying?
Yes and no. I actually, the sticker price on that particular model may in fact have changed, but over the long haul, the total cost of ownership to a consumer on an EV is just fantastic. You have lower maintenance costs overall by a large margin, and your fuel costs are just a fraction of what they would be, a small fraction, driving on fossil fuels. What I think is really driving the price increases is production capacity. The demand from consumers is higher, and you've seen many auto OEMs raise their production capacity estimates on electric vehicles.
Absolutely. No, and listen, we know the wait times are what they are, and again, in some ways, the part shortages and those problems will only exacerbate that in the near term. So again, what can you tell us about, as we start to head into the thick of the summer driving season, what do wait times look like, just overall demand for all the different stations you guys deploy? What are you seeing now, and what should we anticipate in the months ahead?
Well, we reported yesterday year-on-year growth for the year that just ended, 65% year-on-year growth, and the midpoint of our guidance range for next year is 96% growth year-on-year from last year to the year we're in. So we have kept up with demand generally as the demand has escalated just very quickly for our product. And by the way, it's proportional to the new EVs coming on the road. We expect to be able to keep up with demand this year, being mindful very much so of the supply chain impaction that we talked about in our earnings call yesterday.
And a question on the fleet side, where it sounds like interest and activity is really picking up. It seems like a bullish argument on the one hand for all the EV players, but on the flip side, people often roll their eyes and go, yeah, okay, fleet sales is like the least sexy thing of all time, and it's a sign that the industry is maturing, and I'm just curious what your take is on all that.
I think for all of us as consumers, we want to see fleets electrify because the cost structure of a fleet is built into a lot of the things that we all purchase. So it affects all of us, especially in this inflationary environment. It'd be nice to see some counter pressure to that. And while it's not potentially the most glamorous thing to think about, it is a very good business for us. It's growing very quickly. It is at an earlier stage in its growth cycle due to vehicle availability, as you pointed out. But we expect it to get to 100% electrification faster than passenger vehicles because you've got a business buyer on the other side of the table, and they think in dollars and cents. And driving electric for a fleet, it's just cheaper in the long run. Good business for us. We're a software company through and through, even though hardware is a big component of our revenue. And so we see that as a very complex software environment for us to, basically provide a lot of great software and drive shareholder value that way. It's going to be very important.